Gold began 2026 by breaking record after record. Then it fell sharply. So, is this correction a second chance to buy, or a warning that the gold rush has already gone too far? Central banks are still accumulating bullion. Inflation remains above the Federal Reserve's target. Geopolitical risks have not disappeared. But interest rates are also rising. The US dollar could strengthen, and gold produces no income. In this video, we will examine the bull case, the bear case, and the practical question that matters most. Should you buy gold in 2026? Welcome to All Things Gold, where we examine gold prices, precious metals markets, physical bullion, and the role gold can play in protecting long-term wealth. Subscribe for balanced analysis without the hype, fear, or guaranteed price predictions that often surround the gold market. Now, let us look at where gold actually stands in 2026. Gold's performance in 2026 has been extraordinary, but also extremely volatile. Using the LBMA benchmark, gold established more than 12 record highs and reached approximately $5,405 an ounce in late January. By June, it had fallen as low as approximately $4,002. By late July, the benchmark was trading close to $40.50. That means someone buying near the January peak experienced a decline of roughly 25% within a few months. Yet gold remained more than 20% higher than it had been 1 year earlier. The lesson is simple. Even during a powerful long-term advance, gold can produce severe short-term corrections. Several forces explain this volatility. First, geopolitical uncertainty has strengthened safe haven demand. The World Gold Council identified geopolitical risk as the most significant contributor to gold's first-half performance. Second, inflation has remained persistent. U.S. consumer prices were 3.5% higher in June than 1 year earlier, still above the Federal Reserve's 2% objective. However, headline prices fell during June as energy prices declined, showing that the inflation picture remains unstable rather than uniformly worsening. Third, interest rate expectations have shifted. Investors entered the year expecting easier monetary policy, but stronger inflation pressures caused markets to price in higher rates. The Federal Reserve's July monetary policy report indicated that markets expected the federal funds rate to approach 4% by the end of 2026. Higher real interest rates create competition for gold because investors can earn income from cash and bonds. Central bank demand remains an important structural support. Central banks have purchased an average of approximately 1,000 tons of gold annually during the past 4 years, double the preceding decade's average. In the 2026 World Gold Council survey, 89% of respondents expected global central bank gold reserves to increase, while a record 45% expected their own institution to buy more. However, investment demand is not moving in only one direction. Global gold ETFs experienced approximately $8.9 billion of outflows in June, although total ETF holdings were still up by 18 tons during the first half of the year. That suggests strategic interest remains, but investor conviction has weakened since the January peak. The first argument for owning gold is diversification. Gold is influenced by different forces from ordinary company shares. It has no earnings, management team, or business model. Its value is driven by global investment demand, jewelry consumption, central bank policy, currency movements, interest rates, and perceptions of financial risk. This does not mean gold always rises when shares fall. It means gold may behave differently enough to reduce a portfolio's dependence on one economic outcome. The second argument is currency protection. Gold is globally priced and cannot be created by a central bank. When confidence in a currency declines, the local currency price of gold can rise even if the international US dollar price is relatively stable. For investors outside the United States, including New Zealand investors, returns are also affected by the exchange rate. A weaker New Zealand dollar can increase the NZ dollar value of gold, while a stronger New Zealand dollar can reduce it. The third argument is protection against extreme outcomes. Gold can attract demand during financial crises, wars, banking instability, sovereign debt concerns, and severe inflation shocks. It acts less like insurance against ordinary monthly volatility and more like protection against situations in which confidence in financial institutions or government policy deteriorates. The fourth argument is continuing institutional demand. Reported central bank purchases totaled approximately 41 tons in May, led by countries including Poland and China. Central banks cite crisis performance, diversification, inflation protection, and geopolitical risk among their reasons for holding gold. Finally, gold supply cannot respond quickly to rising prices. New mines require exploration, approvals, financing, and years of development. Recycling can increase when prices rise, but mine supply is relatively slow-moving. Gold's role, therefore, is not normally to generate income. Its role is to preserve purchasing power, diversify financial exposure, and provide liquidity during periods of uncertainty. The strongest argument against gold is its opportunity cost. Gold pays no dividend, rent, or interest. When inflation-adjusted bond yields rise, investors can earn a positive real return without accepting gold price volatility. That can place downward pressure on bullion. The second risk is valuation. An asset can have an excellent long-term story and still be a poor purchase at an excessive price. Gold's January to June decline demonstrates how quickly sentiment can reverse after a crowded rally. The third risk is that gold can underperform for years. After peaking in 1980, gold entered a prolonged period of decline and stagnation. By February 2001, it traded at just over $250 an ounce. Investors who bought near the 1980 peak waited more than 2 decades for a sustained recovery. Physical ownership also carries costs. Buyers normally pay a premium above the spot price and may sell below it. Secure storage, insurance, verification, and transportation can reduce returns. Gold ETFs are usually easier to trade, but investors must examine fees, fund structure, liquidity, and whether the product is physically backed, synthetic, allocated, or unallocated. Mining shares are not the same as gold. A miner can be affected by rising labor costs, energy prices, political intervention, poor management, operational failures, declining ore grades, or shareholder dilution. Gold may rise while an individual mining company falls. The final danger is emotional buying. Gold marketing frequently relies on fear, currency collapse, bank failure, or imminent economic disaster. Fear may persuade investors to pay excessive premiums or place too much of their wealth into one asset. Rather than pretending to know one exact future price, consider 3 possible scenarios. Bull case. Gold could resume its advance if geopolitical tensions worsen, global growth deteriorates, financial markets become unstable, or central banks signal lower interest rates. A weaker US dollar and declining real yields would make non-yielding gold relatively more attractive. Renewed ETF inflows could amplify the move. The World Gold Council's mid-year analysis indicated that a strong global slowdown or renewed stress could push gold above approximately $4,500. This is a scenario, not a guaranteed target. Indicators to monitor: real yields, the US dollar, credit spreads, ETF flows, central bank purchases, and geopolitical developments. Base case. Gold could trade within a broad range if inflation remains elevated but manageable, economic growth slows without collapsing, and central banks increase rates only modestly. Under that environment, long-term buyers may support gold near major declines, while high interest rates limit the upside. The World Gold Council's consensus scenario suggested gold could remain within approximately 5% of $4,100 through year-end if current macroeconomic expectations persist. Indicators to monitor: inflation, employment, Federal Reserve communication, physical demand in Asia, and investor positioning. Bear case. Gold could decline further if inflation falls without a recession, economic growth remains strong, share markets rally, the dollar strengthens, and interest rates rise more than expected. Sustained trading below $4,000 could also trigger technical selling and further ETF withdrawals. However, lower prices may eventually attract physical buyers and central banks. Indicators to monitor: rising real yields, dollar strength, weakening ETF demand, declining geopolitical risk, and stronger risk appetite. Gold may be suitable for investors who already have an emergency fund, manageable debt, and a diversified investment portfolio, but want additional protection against currency, inflation, or systemic risk. It may also suit investors with a long time horizon who can tolerate extended periods in which gold falls or produces no return. Gold may be inappropriate for someone who needs regular income, has expensive debt, lacks accessible savings, or is investing money required in the near future. It may also be unsuitable for anyone buying primarily because the price has recently risen or because an online personality predicts the collapse of the financial system. Before asking, will gold rise? Ask a better question. What specific purpose would gold serve in my portfolio? There are several ways to gain gold exposure. Physical bullion provides direct ownership without dependence on a fund manager. However, it involves dealer premiums, storage, insurance, and resale spreads. Recognized 1-ounce coins and widely traded bars are normally easier to resell than unusual collectibles. Allocated vaulted gold gives investors specific ownership of identifiable metal held by a custodian. Confirm who owns the gold, where it is stored, whether it is insured, and what happens if the provider fails. Gold-backed ETFs offer liquidity and convenient trading through a brokerage account. They can be useful for portfolio allocation and rebalancing, but investors should review management fees, custody arrangements, and the prospectus. Mining shares can outperform bullion when margins expand, but they introduce company, operational, and political risks. Royalty and streaming companies finance mining operations in return for a percentage of production or revenue. They can offer diversified exposure with less direct operating responsibility, although they retain commodity, counterparty, and valuation risks. Gold accumulation plans allow regular purchases over time. Their convenience must be weighed against administration fees, dealing spreads, withdrawal restrictions, and whether the gold is genuinely allocated. Avoid any seller using high-pressure tactics, guaranteed returns, risk-free claims, or demands for immediate payment. Regulators identify urgency, exaggerated returns, unlicensed promoters, and unusual payment methods as common warning signs of investment fraud. There is no universally correct gold allocation. As an illustrative framework, not personalized advice, a cautious diversification allocation might be approximately 2 to 5% of investable assets. A moderate strategic allocation might be approximately 5 to 10%. A high-conviction precious metals investor might hold approximately 10 to 15%, recognizing that concentration risk and portfolio volatility increase as the allocation becomes larger. The correct percentage depends on existing assets, income requirements, debt, age, risk tolerance, currency exposure, and the reason for owning gold. Someone whose income, pension, and property are all concentrated in one country may view gold differently from someone with a globally diversified portfolio. Gold should normally be one component of a financial plan, not the entire plan. For investors who decide gold is appropriate, process matters. Avoid investing the entire allocation immediately after a major price surge. Buying in stages can reduce the risk of committing all your money at an unfavorable price. Dollar-cost averaging, or regular investing in equal amounts, removes some of the pressure to predict the perfect entry point. It does not guarantee a profit, but it can improve behavioral discipline. Compare the total purchase cost, not only the advertised spot price. Include premiums, brokerage, foreign exchange charges, storage, insurance, and selling costs. For physical bullion, verify the dealer's reputation, product weight, purity, serial numbers where applicable, and buyback policy. Keep an adequate cash reserve. Gold should not replace money needed for emergencies, household expenses, or near-term commitments. Finally, establish a target allocation and rebalance periodically. If gold rises far above your target, trimming the position may control risk. If it falls below target and the investment thesis remains intact, rebalancing may provide a disciplined buying opportunity. So, should you buy gold in 2026? For some investors, yes, but probably not as an all-in bet. Gold still has a credible long-term investment case. Central banks continue to buy it. Geopolitical uncertainty remains elevated. Inflation is still above target, and gold can diversify portfolios that are heavily dependent on shares, bonds, or one national currency. But gold is not cheap simply because it has fallen from its January peak. It remains historically expensive, produces no income, and could decline further if real interest rates in the US dollar rise. The most defensible approach is to treat gold as a measured strategic allocation. Buy gradually and understand exactly why you own it. Do not buy gold because someone promises that it will make you rich. Buy it only when it strengthens the design of your overall financial plan. Are you buying gold in 2026, holding what you already own, or waiting for a better entry point? Share your strategy in the comments. Subscribe to All Things Gold for more balanced analysis of bullion, mining shares, and the forces moving the gold price. And watch our next video on the biggest factors that could drive gold to new record highs. This video is provided for educational and general information purposes only. It does not constitute financial, investment, tax, or legal advice, or a recommendation to purchase or sell any asset. Gold and gold-related investments can rise or fall substantially, and investors may lose money. Consider your financial circumstances, objectives, and risk tolerance, and seek advice from an appropriately qualified professional where necessary.